This is Rag Bhatia, and this is my second presentation for the retirement group. I'm summarizing the book The Intelligent Investor by Benjamin Graham. Benjamin Graham, or Ben Graham, is known as the father of value investing. He started teaching the concept in Columbia University in 1928. Some of his followers include major investors like Warren Buffett, William Ruane, Irving Kahn. He wrote The Intelligent Investor in 1949. It's known as the Bible of Wall Street. This is a graph of cumulative returns. The SI index here was created for a previous presentation for the retirement group. It takes into account 8 value investors and their average yearly returns. Now if you compare them to other indexes like S&P 500 and Russell 2000, you can see they have much less volatility and greater returns. The intelligent investor. What is the intelligent investor? An important point we need to take into account is we need to differentiate between investing and speculation. In the words of Ben Graham, an investment operation is one which upon thorough analysis promises safety of principal and an adequate return. Operations not meeting those requirements are speculative. If you want to speculate, do it with your eyes open. You should limit your amount of risk and not mix it with your investments. What you need to look at is not IQ. The book shows an example where even Isaac Newton gets influenced by a market and ends up losing about what would be $3 million today. What you need is patience, discipline, thorough fundamental analysis of companies in which you invest, a margin of safety, and you need to work to adequate, not extraordinary, your performance. You need to look at a satisfactory ratio of earnings to price, a company with a sufficiently strong financial position, and the prospect that its earning will at least be maintained over the years. He mentions that there is a paradox in that more successful a company, the greater the fluctuations in the price of its shares, which really just means that the better the quality of a common stock, the more speculative it is going to be. The speculator's interest lies in anticipating and profiting from market fluctuations, whereas an intelligent investor focuses on acquiring suitable securities at suitable prices. Aim to be an intelligent investor, not a gambling speculator. The dot-com bubble. It was the result of a combination of rapidly increasing stock prices, market confidence that the companies would turn future profits, and a lot of individual speculation on stocks. All of this led a lot of investors to overlook merits like the price-earning ratio in favor of confidence in technological advancements, companies like Amazon.com. And then the bubble burst. Amazon stock went from $107 to $7 per share. The Nasdaq Composite, as shown here, lost 78% of its value from the peak as it fell from 5,046 to 1,114 points. He says that basically there are 2 types of investors, the defensive investor and the enterprising investor. The defensive looks for safety and freedom from bother.